Welcome to TradeTheMBI.com. This is John. This report is for the 3rd of January. Well, we noted on our video at the end of the year how we were ending on a bit of a soft note from our 50K readings, which suggested some weakness, and we opened up just pretty close to even, but right at our ABM yellow, and we dipped all the way to the ABM magenta, back up, didn't even make it to the ABM green. And we talked about this range between the 76 and 100 was just so great that it eventually is going to have to smooth out a bit and shrink in order for normalized movement to take place. Now, filled in all of our positive extremes going back through here, but bear in mind you've got positive extremes going all the way back here as well as here. So I marked some of those levels going all the way back to the initial breakout. So it just gives an idea of clearly defined points, and we talked about this as well. This is the dip below the negative 13.5 on the DOC steel here, generating the weakness as the same for the Nasdaq. So it doesn't matter whether I'm showing the S&P and that; they're pretty much identical at this particular stage from our reading. We got a strong DOC spread, which is always a good indication for weakness, and significant rise in MBI white back above that 10 once it got over the 6 range, pretty solid at that particular point. And we were right at 5.3 to end the year. So beginning out, started to climb, and you can see a significant progression of that. And dip below the red line, interesting. Getting a dip below the red line this high up, it's going to be interesting to see if they're able to break even the 76. Now the NQ is a lot closer than the S&P, at least from that range, so it gives it a little bit more potential. But once that DOC steel comes back up from the negative 13, that's just like a new set of buyers. And of course, new fund money comes in very shortly. Treasuries, which had gotten way out, are still way out, but backed off quite a bit, and the yield improved slightly because it was just going nonsense direction, expecting the Fed to cut rates back to zero, which, if the entire economy were falling off, that would make sense. But if that were the case too, the market would also have to nosedive because everyone would realize that earnings would fall apart. So some things are just waves of exuberance in that. From a oil standpoint, the softening there, it's healthy still, above range, just not promoting additional inflation, but you're certainly not seeing anything coming back from where it was. The ridiculous move in the euro faded off just a little bit, still way elevated. They're very happy with where that is because it's definitely outside their danger zone, which is where they were at back in October. And then you started getting a artificial pump, not based on anything until right as the beginning of the rally, and this is where people obviously knew that the Fed was going to start making some changes. And finally, when they announced it, everyone had already started the rally from earlier. From a gold standpoint, weakened just a little bit. It was interesting because you saw a massive pump in crypto from Bitcoin shooting all the way up there, and it gave back about half of that just to go right back into that normal range. But it broke out to new highs, and you've got the beginning of the year with the hype of crypto exuberance and the imminent approval of ETFs, as if that's we've been trading the futures on Bitcoin for how long? So ETF opens it up to find what, I guess, regular people. Doesn't make any sense, but okay, everyone believes that that's going to do it. I think the halving is more of a significant one because you have all these Bitcoin miners who are going to suddenly get half of what they were getting. So the price really needs to escalate in order for them to maintain their earnings. From an ETH standpoint, looking pretty much identical, still decent readings, and there's no question, as debt spending and everything gets fueled, you're going to have this continuation of a desire to move towards something that isn't just getting debased exponentially. And it's an interesting one because, like we've talked about, the eventual move towards the tokenization of everything, and you could literally off put all your debt into some kind of token coin and literally kind of wipe it out, so to speak. But it'll be interesting. This was a fun one. We were talking about intraday move, and as things started getting weaker, there was a question about, well, what would be the potential low? And this isn't something to talk about much, but there's several ways that you can calculate what an expectation is. And here's an interesting one that I use: is when the shakeout dips to a negative 13. Um, this line is negative 13.5 that's on your regular charts, but negative 13 usually works for it. And then you just go back to, I'll just go ahead and put that up there so you can see it, negative 14. And you go back to the first positive extreme before it breaks down. And the distance between those closes, so from the 32 to the 09, roughly 20 points. So the expectation is you would have 20 points from this close lower. And we talked about that. I think it led to a 47.69 was the projection, as I pointed out. It's going to take a little bit back and forth sometimes to get there. Sometimes it happens immediately, but overall, that's where the algorithm targeting is based. And this only works when you have a dip below the negative 13.5. If it's shallower than that, you're not going to get the same kind of effect. But once we got back up to that 48.09, it was made it easy for the entry, which was literally during the day, or even if it's later in the day and you're like, well, how much further can it go? We're getting close to the zero. Well, you can see that even, if you waited all the way until here and you were in the 47.90 range, you still had a potential for, almost, 20 some points. And sure enough, what did we get? 47.66 was that close, the low 65.50, off by a few points on the calculation, but effective nonetheless. So just thought I'd throw that out there. What always says, well, it's not a prediction because these are moves that are made by computers with specific ideas. The difference is that where they begin their calculation from has always been, the great unknown, except for the fact that that's what we see within our extreme histograms, and looking for the positive extremes as well as the dips below the red line for retraces, and that's where they've done their move, and that's how they work it. When we look at it from an intraday, we had this nice rally that was starting to take things up, and then it started to all fall apart, only to come right back up towards the end of the day. So it was just back and forth, pretty much neutral, but did give us exactly what the target was, which is exactly how they do things to get it there. So we can see from here, because when I tried to do my 5-tick chart, it collapsed, and so I've had to go back here. So this is where we're currently at. You can see we filled in these positive extremes from the other day, and that leaves just a little bit further to go, down to 73 to get to the other positive extreme, and the loop is completed and it starts over again. So clean action to start the year. All good. Have a good one. Trade well. Anything relevant like that, I will put on the Skype chat. Have a good one.